All right, so get this. We're diving into your stack of articles about the Dow, and the first thing that jumps out is this weird situation. A killer jobs report actually sent the market plummeting. Usually good news means stocks go up, right? So what's the deal?
Yeah, it definitely seems counterintuitive, right?
Mm.
That's the thing about the market. It's not always as straightforward as it seems. There's a lot of psychology and anticipation baked into how investors react.
Okay, so we're going to need to unpack this. You sent over some great articles from Investors Business Daily, CNN Market Watch, and Business Insider. Let's see if we can crack the code on this market mystery.
Absolutely. Let's break it down. Seeing it from different angles can help us understand the bigger picture.
So let's start with the IBD article, which gives us a good overview of what's been happening with the Dow. For anyone just tuning in, the Dow Jones Industrial Average, or Dow for short, is like the who's who of American companies, 30 big hitters across various industries. It's often seen as a barometer for the overall U.S. economy.
Yeah. Exactly. Think of it as a temperature check on investor confidence. When the Dow is up, it usually means people are feeling optimistic about the future of the economy.
And right now, it seems like that optimism is taking a bit of a hit. IBD points out the huge difference in performance among Dow stocks last year. NVIDIA was the rock star, surging a whopping 171.2%. Walmart also had a strong year, up 71.9%. And American Express wasn't far behind with a 58.4% gain.
Yeah, that's a good reminder that even when the overall market is down, there are always individual companies and sectors that outperform it. Speaks to the importance of researching specific companies rather than just looking at the overall market trends.
Totally got to look under the hood, so to speak.
Right.
But it wasn't all sunshine and rainbows, was it? Boeing had a rough year, dropping 32.1%. Nike took a tumble, down 30.3%, and Amgen dipped 9.5%.
Right. Those examples show that even within a major index like the Dow, individual companies face unique challenges and opportunities that can significantly affect their performance. It's not a monolithic entity.
Makes sense. IBD also gives us some context by mentioning how other major indices fared. The S&P 500, which tracks a wider range of 500 companies, was up a healthy 23.3%, while the tech-heavy Nasdaq, home to the likes of Apple and Microsoft, surged an impressive 28.6%.
Yeah, that broader context is important because it tells us that while the Dow's decline is significant, it's not necessarily indicative of a complete market meltdown.
Okay, so it's not a total free fall, but still a big drop after a good jobs report is strange. Let's dig into that CNN article, which goes right to the heart of this puzzle. Why did the Dow plummet nearly 2%, a whopping 697 points after seemingly fantastic news about job growth?
Well, the December jobs report showed a massive 256,000 new jobs added to the economy that blew past the projected 153,000 new jobs, which on the surface seems like a reason to celebrate.
Right. More jobs usually means a stronger economy, which should be good for stocks. So what gives us...
That's where things get interesting. Instead of cheering, investors seem to have gotten spooked. The S&P 500 and Nasdaq also fell by 1.5% and 1.6% respectively. Even the Russell 2000, which tracks smaller companies, dropped 2.2%. It seems like everyone saw this strong jobs report as a potential warning sign.
So it's not just the big players feeling the heat. This widespread decline suggests something bigger is at play. What's the leading theory?
The main culprit seems to be rising interest rates. Here's the logic. A booming economy might make the Federal Reserve think, hold on, things are getting too hot. We need to raise interest rates to cool things down and prevent inflation from spiraling out of control. And while that's good for the economy in the long run, it can create short-term pain for businesses.
Especially for smaller companies who rely on borrowing to grow their businesses, right?
Exactly. Higher borrowing costs can squeeze their profits and make investors nervous. The CNN article also points out that another factor adding to the anxiety is President-elect Trump's stance on tariffs. Remember those proposed tariffs and potential emergency declarations to implement them? Investors are worried about what that might mean for global trade and ultimately corporate profits.
So we've got this potent cocktail of good news, potentially leading to higher interest rates coupled with uncertainty around trade policies. No wonder investors hit the panic button. What's particularly interesting here is that the market's reaction suggests a real shift in mindset. Instead of celebrating positive economic news, investors are focusing on the potential downsides and risks associated with rapid growth. What does that tell us?
Well, it tells us that fear of inflation is a powerful force in the market right now. Investors are worried that the Fed might have to hit the brakes on their rate-cutting policies or even raise rates to keep inflation in check. That would make borrowing more expensive and could potentially slow down economic growth.
So good news is actually bad news because it might mean the good times can't last forever. That's a pretty wild concept.
It is, and it shows how investor psychology can be just as important as the underlying economic data.
It makes you realize the market isn't just about numbers. It's about how people interpret those numbers and what they think those numbers mean for the future.
Absolutely. It's a fascinating interplay of psychology and economics.
CNN also highlights that some big-name stocks led the downward charge. NVIDIA, despite its incredible 2024, fell 3%. Apple slipped 2.4%, and Palantir, the data analytics company, dropped 1.4%.
Yeah, it's a good reminder that even industry leaders aren't immune to broader market trends and investor anxieties. It underscores the importance of diversification in any investment portfolio. Spreading your investments across different sectors and companies can help mitigate the risk of any single stock taking a big hit.
Okay, so we've got a booming economy, rising interest rate worries, and the specter of trade wars looming large, plus even the big tech giants aren't safe. To understand the interest rate piece of this puzzle a bit better, let's turn to the articles from MarketWatch and Business Insider. They dive deeper into the rising bond yields that seem to be at the heart of this market downturn. But before we get into the nitty-gritty of bond yields, can you give us a quick refresher on what they are and why they matter?
Sure. Think of a bond like an IOU issued by a government or a company. When you buy a bond, you're essentially lending them money, and in return, they promise to pay you interest over a set period of time and then return your principal investment at the end of that period. The yield on a bond is the annual return you get on that investment expressed as a percentage. Now, here's the key. Bond yields and prices move in opposite directions. When bond yields rise, as they have been recently, bond prices fall.
Okay, I'm following so far. So as bond yields climb, their prices drop. What makes the situation especially confusing is that bond yields are typically driven by inflation expectations. When investors expect higher inflation, they demand higher yields on bonds to compensate for the eroding value of their money. But in this case, the strong jobs report is actually fueling concerns about future inflation leading to those rising bond yields. So it's like good news about the economy is triggering a sell-off in bonds, which in turn is making stocks look less appealing.
Exactly. It creates this good news is bad news dynamic that's puzzling a lot of people.
It's like investors are playing a game of economic chicken, trying to predict when the music will stop and the Fed will be forced to slam on the brakes or even hike rates again.
Right, and that uncertainty is contributing to the market jitters. MarketWatch points out that this fear of a higher for longer interest rate environment, meaning rates staying elevated for a longer period, has really flipped the script on how investors are interpreting positive economic signals.
Okay, so we've got a strong economy, perhaps even too strong for its own good. Rising bond yields, spooking investors, and a whole lot of uncertainty around what the Fed is going to do next. Before we throw in the towel and head for the hills, let's add one more layer of complexity to this President-elect Trump's unpredictable policy agenda.
Right, as both MarketWatch and Business Insider point out, Trump's proposed policies, particularly those focused on tariffs and tax cuts, are injecting a healthy dose of uncertainty into the market. Let's break it down. While tariffs are meant to protect domestic industries, they can lead to higher prices for consumers, which is never a good thing. Plus, they have the potential to disrupt global trade, which can ultimately hurt corporate profits.
And while tax cuts often sound good in theory, especially for businesses, they can sometimes backfire, right?
They might offer a short-term boost, but they can also contribute to larger budget deficits in the long run. And that can potentially lead to, you guessed it, even higher interest rates down the line.
It's like we're stuck in this economic feedback loop where every solution seems to create a new problem. No wonder investors are feeling a bit queasy. To get a better sense of how all of this is playing out at the company level, let's go back to the IBD article. It provides some interesting examples of both winners and losers in this turbulent market.
I agree. Looking at specific company performances can be really insightful. It helps us understand how different sectors and industries are being impacted by this economic climate and those shifting market trends.
Exactly. So let's kick things off with a sector that seems to be defying gravity while the rest of the market struggles, the airline industry. IBD highlights Delta Airlines, which surprisingly reached an all-time high, breaking through previous records. And they weren't alone. United Airlines and American Airlines also hit record highs.
It's a fascinating contrast, isn't it? Especially considering that the airline industry is traditionally considered very cyclical. Their performance usually mirrors the health of the economy. When times are good, people travel more and airlines thrive. But when the economy slows down, people cut back on travel and airlines suffer.
So why are they soaring now when there are all these warning signs flashing about a potential economic slowdown?
That's the question, isn't it? There are a few possible explanations. One thought is that lower fuel costs are boosting airline profitability. They're saving money on one of their biggest expenses, which allows them to offer more competitive fares and attract more passengers.
Makes sense. If it costs less to fly, more people are likely to take to the skies. What are some of the other potential factors?
Another possibility is that there's simply more demand for travel right now. Perhaps it's pent-up demand after a period of economic uncertainty, or maybe people are shifting their spending habits away from material goods and towards experiences like travel. If people are thinking, hey, if the economy might slow down, let's enjoy life now and take that dream vacation, that would certainly boost airline profits.
I love that explanation. It speaks to this human need to seize the moment and make the most of life, even when things are a bit uncertain. But as we know, not all sectors are experiencing this kind of high-flying success. IBD also spotlights a company that took a hard landing due to events in the real world. Mercury General, the insurance provider. Their stock plummeted because of their exposure to the devastating California wildfires.
Yeah, that's a sobering reminder that the stock market isn't immune to the realities of the world around us. Natural disasters, geopolitical events, unexpected occurrences, they can all have a significant impact on specific companies and entire industries. It highlights the importance of considering those potential risks when evaluating investments.
It really drives home the point that the stock market isn't just this abstract game played on computer screens. It's intertwined with the real world, and events beyond our control can shake things up drastically.
Precisely. And in the case of Mercury General, those devastating wildfires resulted in major financial losses for the company, directly impacting its stock price.
It's a tough lesson for investors, showing that even companies with solid fundamentals can be vulnerable to forces outside their control.
Absolutely. Which brings us back to the importance of diversification. By spreading your investments across different sectors, industries, and even asset classes, you can potentially mitigate the impact of any single event on your overall portfolio.
So we've seen how some companies are riding high while others are struggling, all within this broader context of market uncertainty. IBD also mentions several other companies with varying performances, like Taiwan Semiconductor, Globus Medical Aris Water Solutions, Arctrock, and Intap.
Right, and these diverse outcomes underscore that there's no one-size-fits-all approach to investing. It requires careful research, due diligence, and a willingness to adapt as circumstances change. You need to understand the individual company, its strengths and weaknesses, and the dynamics of its industry.
It's like navigating a constantly shifting maze. You need a good map, a compass, and maybe even a guide to find your way through.
That's a great analogy. The more knowledge and understanding you have, the better equipped you'll be to make informed decisions and navigate the market's inevitable twists and turns.
Absolutely. IBD wraps up their analysis with a look ahead to the upcoming fourth quarter corporate earnings season. They suggest that strong earnings growth could potentially boost market sentiment and give jittery investors some much-needed reassurance.
Yeah, earnings season is always a critical time for investors because it provides valuable insight into the financial health and profitability of companies. But this time around, it feels even more significant given the current market uncertainty if companies can demonstrate strong earnings growth despite these headwinds. Rising interest rates, potential economic slowdown, it could help restore investor confidence and maybe even spark a market rebound.
It's like getting a progress report for the economy as a whole. If companies can show they're still making good grades despite a tougher curriculum, maybe investors will feel better about the future.
That's a great way to put it. While earnings season can always bring surprises, it's going to be fascinating to see how companies perform in this environment and what their outlook is for the year ahead. Welcome back. I'm eager to dig into those company-specific examples from the IBD article. Remember, we're looking for clues about how different sectors are reacting to this economic puzzle we've been discussing.
You got it. It's like putting those detective skills to work, right? Analyzing those individual companies, trying to see if we can spot any patterns, any insights that might give us an edge in understanding this market.
Exactly. So let's revisit that surprising performance from the airline industry. Delta United and American Airlines all hitting record highs despite the market downturn. It really does seem counterintuitive.
It's like they found a secret updraft while everyone else is being pulled down by gravity. Remember, we talked about lower fuel costs and a possible surge in travel demand as potential explanations.
Right, those are definitely key factors to consider. But the IBD article actually dives a bit deeper, highlighting some interesting details that might shed even more light on this airline phenomenon. For instance, they point out that the airline industry has been consolidating in recent years. Fewer major players means less competition, which can lead to higher fares and potentially bigger profits.
So it's not just about the cost of fuel and how many people are flying, it's also about the structure of the industry itself. Fewer airlines vying for passengers could mean more pricing power for those that remain. That makes sense.
Exactly. And IBD also mentions that airlines have been working hard to improve operational efficiency, which can translate into lower costs and higher profits. They've been streamlining their routes, updating their fleets with more fuel-efficient aircraft, and investing in technology to improve everything from baggage handling to customer service.
So they're getting leaner and meaner, squeezing more profit out of each flight. It's like they've gone through a corporate boot camp and emerged stronger and more competitive.
That's a great way to put it. And it shows that while external factors like fuel prices and travel demand are important internal factors, the decisions companies make about their operations and strategy can also have a big impact on their performance.
It's a good reminder that even in a challenging market, companies that adapt and innovate can find ways to thrive. But on the flip side, as we saw with Mercury General, even companies with solid fundamentals can be vulnerable to events outside their control.
Absolutely. IBD's analysis of Mercury General is a stark reminder that risk assessment is a critical part of investing. In this case, there's significant exposure to the California wildfires, which unfortunately are becoming increasingly frequent and severe, led to substantial losses that directly impacted their stock price.
It's like a wake-up call for investors to think beyond just the financial numbers and consider those real-world factors that can impact a company's bottom line. Climate change, for instance, is creating new risks and opportunities across various sectors.
Right. As we evaluate companies, we need to ask ourselves, what are the potential risks and vulnerabilities specific to this company or industry? How are they managing those risks? It adds another layer of complexity to the research process.
It makes you realize there's a whole lot more to investing than just looking at PE ratios and earnings reports. It's about understanding the broader context, the forces at play in the world that can shape a company's fate.
Exactly. It's about connecting the dots between the financial data and the real world. Speaking of connecting dots, IBD also highlights a few other companies with diverse performances. Taiwan Semiconductor, Globus Medical Aris Water Solutions, Archrock, and Intap.
Right, and I think these examples are really helpful because they show that even within this turbulent market environment, there are companies finding success. It's not a one-size-fits-all situation.
I agree. Taiwan Semiconductor, for instance, saw its stock price rise despite the broader market downturn. They're a major player in the semiconductor industry, which is benefiting from strong demand for chips, used in everything from smartphones and laptops to cars and data centers.
It's like they're riding a wave of technological advancement, and that momentum is strong enough to overcome those broader market headwinds.
Exactly. And then you have companies like Globus Medical, which focuses on musculoskeletal implants. They also saw their stock price increase, likely driven by factors like an aging population and advancements in medical technology.
So even in a potentially slowing economy, there are sectors like healthcare that tend to be a bit more resilient. People still need medical care, regardless of what's happening with interest rates or trade policies.
Right. And those long-term trends, like an aging population, can create consistent demand for certain products and services, regardless of the short-term economic fluctuations.
It's like looking for those investment opportunities that are driven by forces bigger than just the economic cycle.
Precisely. And then you have companies like Aris Water Solutions and Archrock, both of which operate in the energy sector. Their stock prices went in opposite directions.
That's interesting. What's driving that divergence?
Well, Aris Water Solutions focuses on water management for oil and gas producers. As the energy industry shifts towards more sustainable practices, the demand for their services is increasing.
So they're benefiting from this transition towards cleaner energy production. That makes sense. What about Archrock?
Archrock, on the other hand, provides natural gas compression services as the world moves away from fossil fuels. Demand for their services might be declining.
Ah, so they're facing headwinds from that same shift towards cleaner energy. It's a great example of how a major trend like the transition away from fossil fuels can create winners and losers within the same sector.
Exactly, and it highlights the importance of understanding the nuances of each company's business model and how they're positioned within their industry.
Makes you realize that investing is like playing a game of multi-level chess. There are so many pieces moving at once, so many factors to consider.
It certainly is, and that's why it's crucial to stay informed, keep learning, and continuously refine your investment strategy. Remember, knowledge is your most valuable asset in this game.
Absolutely. Speaking of knowledge, IBD wraps up their analysis with a look ahead to the upcoming fourth quarter corporate earnings season. They suggest that strong earnings growth could potentially boost market sentiment and provide some much-needed reassurance to jittery investors.
I agree. Earnings season is always a crucial time for investors. But this time around, it feels even more significant. We'll be watching closely to see how companies are performing in this environment and what their outlook is for the year ahead. If they can deliver strong earnings despite those headwinds we've been discussing, it could signal that the economy is more resilient than some fear, and that could potentially calm the markets.
It's like waiting for the results of a stress test. If companies can show they're in good shape despite the pressure, it might give investors more confidence.
Exactly. And remember, earnings reports aren't just about the numbers. They also provide valuable insights into how companies are adapting to these challenging times. Are they cutting costs? Investing in new growth opportunities? How are they managing their debt? These are all important clues that can help us understand their long-term prospects.
So it's like getting a behind-the-scenes look at how companies are navigating this complex economic landscape.
Right, and by studying those strategies and decisions, we can learn valuable lessons that can inform our own investment approach.
I love that. It's like we're not just passively watching the market, we're actively trying to understand its inner workings so we can make smarter decisions.
Exactly, and the more we learn, the more confident and empowered we become as investors. Now, before we move on to part 3, where we'll synthesize all these insights and leave our listener with some final thought-provoking questions, I'm curious to get your initial impressions. What are some of the key takeaways that are sticking with you from this deep dive so far?
That's a great question. There's certainly a lot to process, but a few things stand out to me. First, it's clear that the market is a complex, interconnected system. It's not just about what's happening in the U.S. economy. Global events, industry trends, technological advancements, even things like climate change. They all play a role in shaping the market landscape.
I completely agree. It's like trying to understand a living organism. It's constantly evolving, responding to internal and external stimuli.
Right, and that brings me to my second takeaway. There's no simple formula for success in investing. It's not just about following the herd or chasing the latest hot stock tip. It requires careful research, thoughtful analysis, and a willingness to adapt your strategy as conditions change.
That's a core principle of sound investing.
Yeah.
There's no magic bullet, no easy path to riches. It requires diligence, patience, and a commitment to continuous learning.
Absolutely. And my third takeaway is the importance of remembering that investing is ultimately about people. It's about understanding investor psychology, how fear and greed can drive market movements, and how our own biases and emotions can influence our decisions.
I could have said it better myself. The human element is often overlooked, but it's absolutely essential to understanding how the market works and making informed investment choices.
So it's not just about the numbers, the charts, and the economic indicators. It's also about understanding ourselves, our own motivations, and how our minds can both help and hinder us on our financial journey.
Precisely. And that recognition, that awareness of the human element can be incredibly empowering. It allows us to take control of our financial future and make decisions that align with our values and goals.
That's a powerful message, and I think it perfectly sets the stage for part 3 of our deep dive, where we'll pull all these threads together and leave our listener with some final thought-provoking questions to ponder.
I'm ready. Let's dive in.
Okay, so we've journeyed through a lot of information about the Dow's recent roller coaster ride. We've dissected a confusing jobs report, delved into the bond market, and even peeked behind the curtain of how companies are adapting to this turbulent economic landscape.
Yeah, we've covered so much ground. It's fascinating how everything is interconnected. From global events to individual company decisions, there's a whole symphony of factors influencing the market.
Exactly. And amidst all this data, one thing keeps coming back to me, the human element. It's like the market is a giant mirror, reflecting our collective hopes, fears, and uncertainties about the future.
That's such a powerful insight. We often get caught up in the numbers, the charts, and the technical analysis, but ultimately, the market is driven by human decisions, human emotions.
And those emotions can be pretty unpredictable, can't they? One minute, we're celebrating a booming jobs report. The next, we're panicking about rising interest rates. It's like we're trying to guess what's going to happen next. And that uncertainty can create a lot of anxiety.
Absolutely. That uncertainty is inherent to the market.
Yeah.
And learning to navigate it is part of the challenge and the excitement of investing. It's about finding that balance between being informed and aware of the risks without letting fear paralyze us.
So how do we strike that balance? How do we make sense of all this information, all these competing narratives, and make informed decisions about our own portfolios?
Well, I think one of the most important things is to develop a clear investment philosophy, a set of guiding principles that can help you stay grounded amidst the market's ups and downs.
So it's not just about picking stocks or chasing returns. It's about having a framework, a way of thinking about investing that aligns with your values, your goals, and your risk tolerance.
Exactly. It's like having a compass to guide you through the fog.
Hmm.
It can help you stay focused on the long term and avoid making impulsive decisions based on short-term market fluctuations.
That makes a lot of sense. So if our listeners feeling a bit overwhelmed by all this information, what's a good first step towards developing that investment philosophy?
I think the first step is to really understand yourself as an investor. What are your financial goals? What's your time horizon? How much risk are you comfortable taking on? These are fundamental questions that will shape your investment approach.
So it's about self-awareness, understanding your own needs, your own comfort level, and your own vision for the future.
Exactly. Once you have a better understanding of yourself as an investor, you can start to develop a strategy that aligns with those needs and goals. Are you looking for long-term growth, income generation, capital preservation? There are different investment approaches that can help you achieve those objectives.
And that's where research and education come in, right? Taking the time to learn about different asset classes, investment strategies, and the factors that drive market performance.
Absolutely. The more knowledge you have, the more empowered you become as an investor. It's about being curious, asking questions, and constantly seeking to expand your understanding of the market.
So as we wrap up this deep dive into the Dow, I think the key takeaway is this. It's not just about the numbers, it's about the people. It's about understanding ourselves, our emotions, our biases, and our goals, and using that knowledge to navigate the complexities of the market with confidence and clarity.
Beautifully said.
Yeah.
And remember, the market is always evolving, always presenting new challenges and opportunities. The key is to stay engaged, stay informed, and never stop learning.
And to always remember that investing is a journey, not a destination. It's about making smart choices, managing risk, and patiently pursuing your financial goals over time.
Exactly. And while the market may seem daunting at times, remember that you have the power to take control of your financial future and shape it in a way that reflects your values and aspirations.
I think that's a perfect note to end on. So to our listener, thank you for joining us on this deep dive into the Dow. We hope you found it insightful, thought-provoking, and perhaps even a little bit empowering.
Until next time, stay curious, stay informed, and stay invested in your own financial well-being.
And remember, knowledge is your greatest asset.